As I was scrolling through Snapchat, I came across this video. This is when I realized what Tennant was capable of. Tennant designs, manufactures, and markets a variety of cleaning solutions, all of which increase cleaning productivity. They sell this through a variety of channels, their largest coming from direct sales. They sell to various markets, and with big name customers like Walmart, we expect Tennant's management's goal of transitioning from a big little company to a little big company to come to fruition.
Tennant operates out of 13 manufacturing firms, selling to nearly 40,000 customers from all around the globe each year. Some of their key sales statistics are $1.1 billion in sales revenue, accompanied by a $120.8 million EBITDA, adjusted EBITDA. We realize that these key sales statistics may cause one to think, oh, buy. However, we realize there needs to be a healthy mesh between quantitative and qualitative analyses to come to this conclusion. We think that Hannah's video that she just showed says to us that people that know nothing about Tennant or nothing about the scrubber and sweeper industry are excited about the innovation that's coming forth from it. Over the next 8 or so minutes, we plan to show you using our 3 pillars, which are financial stability, competitive advantage, and growth potential, how we came to the conclusion to buy.
First, we'll start with financial stability. Tennant reported its third quarter results last October. While revenue was slightly below expectations at $281 million, strong gross margins and increased operating efficiencies led to high EPS upside. There is strong organic growth in the Americas at 6 to 7%, while EMEA and the APAC regions struggled with negative organic growth. Gross margins at 40.8% were 1 to 2 percentage points above expectations, with SG&A expenses coming in $3 million below most models. We expect Tennant to target their higher margin products and to condense their sales mix, with discontinuations leading to higher gross margins in the future.
Benchmarking ratios is a great way to understand a company within its industry. As Tennant's direct competitors are private, we chose 4 companies within the industrial machinery industry to benchmark. These companies are Graco, Toro, Middleby Corp, and Standex International. The first standout liquidity ratio is the current ratio. At 1.88, Tennant is currently 18% below industry average. Too high of a current ratio can signify the inefficient holding of cash, and we are pleased to see that Tennant has a strong liquidity ratio while remaining under industry average. The leverage ratios are all heavily impacted by the material acquisitions Tennant has embarked on. As revenues have proved to grow and grow based on these acquisitions, as well as market share, these are well worthy of the debt incurred in our eyes. The days of inventory ratio has steadily decreased in the prior 3 years, beating industry average. As this is signifying that inventory is flying off the shelves and sales are becoming more efficient. As days of inventory decreases and Tennant's market share as well as prices increase, Tennant is poised well for the future.
Next, we'll look at Tennant's competitive advantage. First, they're live within the $5 billion industrial cleaning industry, where they're the market leader with 20% share. They operate at a 10% price premium due to their innovation and great service. And just in the last 2 years, they've increased their market share by 2%, along with competitors Nilfisk and Karcher, each gaining 1% share. Given this trend, we expect the 38% of the market held by firms with 3% or less to decrease.
Tennant has been gaining competitive advantage in its industry in the following ways. First, Tennant has been rationalizing its diversified product offerings and shifting focus to its strongest selling products while maintaining that price premium. Secondly, Tennant's acquisitions, both horizontal and vertical, have allowed them to access new regions and excuse me. So lastly, Tennant has a goal of 30% of sales to be from products launched within the last 3 years, and they have a target of 3% of sales to be invested into research and development. This has allowed them to launch products such as their T7 AMR, and with this they've launched a deal with Walmart, whose reputation as a leading smart company could generate a domino effect in sales as other companies look to follow suit.
Our third and final pillar is the growth potential of Tennant. How we analyzed this was using the Purchasing Managers Index, PMI, and looking at the countries in which Tennant manufactures in. We then grouped this into 3 regions, being the EMEA region, the Americas, and the APAC region. So to first dive into the EMEA region, this scored below our 50-point threshold, which may raise some concerns. However, we see that because this area generated 30% of our sales revenue in 2018, and a lot of the industry competitors are also facing some of the economic problems in the EMEA region, that this wasn't a major concern. Our second region is the Americas. In the Americas, 60% of sales revenue was generated in this region in 2018, and this scored above our 50% threshold, indicating a healthy manufacturing economy. Therefore, we saw that because of our strong sales revenue in this region, that growth would continue. Our last and third and final region is the APAC region. This was responsible for roughly 10% of our sales in 2018, and this also scored above that 50-point threshold, indicating a good manufacturing economy, and we see a lot of potential in this area, and Hannah will show us why.
So we see growth in the APAC for 3 primary reasons. First, the recent acquisition of Gaomei, who designs and manufactures similar product as Tennant, allows them to enter the Chinese market. Second, the competition. Nofus has been struggling recently, and especially within this APAC region, where they saw negative 5.4% growth, and they actually completely discontinued their Nofus products here. Third, the minimum wage in China has been steadily increasing over the last 12 years and is expected to continue this trend. Given that Tennant's primary substitute is the mop and bucket, we see Tennant's products could help combat these newly raised labor costs.
With any investment comes risks. The biggest risks we identified for Tennant are a competitor coming out with a less expensive AI product directly or undercutting sales, reluctance from Asian markets, a stock market cap to GDP ratio signaling a potential correction in the market, and a low concentration in the industry. Now under our evaluation, we began with the Tennant management guideline that the industry grows at the same rate as GDP. From there, we added in our findings from our 3 pillars to come to a 4% revenue growth rate.
We utilized 2019 data through Q3 to forecast our 2019 predictions. We took the percentage difference from Q3 to Q4 over the past 3 years and applied the average to 2019 Q3. The sum of actual data through Q3 and our 2019 prediction yield our 2019 figures. Beyond 2019, and aside from the 4% revenue growth mentioned, all predictions are based off historical trends, future expectations, and team assessment.
We realized that WAC plays a crucial part in our DCF valuation. And included on our slide is a sensitivity table showing how our valuation changes with WAC and terminal value as the inputs. We came to a final WAC value of 9.29% with a terminal growth rate of 2%, which then yielded a 26.8 market cap premium.
Next is our guideline company valuation. We used these companies in the valuation, and we came up with an equity value just over $1.67 billion after weighting these. The weighted average of our guideline company as well as our DCF came to a 19.43% undervalue of Tennant, putting a share price at $103.28. This decision was made on January 17th when Tennant's share price was $84.58.
In the past few days, as we've been putting together our presentation, we actually stumbled across a few assumptions that we made in our model, and we're actually which we corrected for, and this caused us to change our new valuation to 83.49, indicating a hold recommendation. Thank you once again. We're Team CSB SJU, and we'd like to open the floor for questions.
So you mentioned that a risk to tenant could be a competitive company coming out with a lower cost autonomous scrubber. In your research, did you find any competitors that do have a product potentially coming out soon that could compete with their new brain autonomous scrubber, and kind of where they're at in that process?
Okay. Yes, we believe that Nilfisk actually may have already come out with their new autonomous product, or it's in the works. But Tenet still strives to. Tenet still believes that their products operate at a higher level of quality than their competitors, so we don't think it'll be too big of a risk that they'll have a product that's beneath it. That is also an AI product.
Okay, so based on your research, so what kind of industry trend you're seeing for next maybe 3 to 5 years, and what's the market growth rate, and why do you think tenant can grow above the market rates?
Can you repeat the question?
Sure. I was saying that based on your research, what's the industry trend? That cleaning machine industry, what's the trend you're seeing next 3 to 5 years, and what's the market growth rate, and why you think tenant can grow faster than market?
So we see that like growing at like the same in the market in areas like the Americas or EMEA, who has already like been there, but we see it more primarily within the Asian economy, who hasn't hit that market yet. Especially and just with the AI, it kind of brings the market to the Americas and EMEA as well, because as wages increase, they're going to be looking for ways to cut those costs. So we see the AI technology as an easy way for them to do that.
Along with this, China and a bunch of the Asian markets are growing at alarming rates. They're going really fast. Infrastructure, and such as buildings, hospitals, airports, etc., are going up, and they need to be cleaned. Wage rates are increasing, and that creates more demand for autonomous cleaning services such as Tenet.
Okay, thank you.
I wonder if you can sort of walk us through your expectations for margins going forward and why.
Going forward, tenant management, or at Investor Day, tenant management explained how they're cutting bad business deals and cutting down less marginal products. Also in Q3, the SG&A expenses were below most models' expectations, and so going forward, we expect them to continue targeting their higher margin products that they're not discontinuing, thus increasing profit margins.
We know just the last quarter they cut out their outdoor cleaning equipment. That's the Sentinel and another machine. So we think that their plan is to kind of focus on their money-making products, which are primarily their sweepers and scrubbers.
To address the valuation side of things, I saw that you were using the weighted average cost of capital and the DCF models. As you looked at things in recent times and you lowered your stock price, what was the key driver of that change?
So it had to do with our terminal value and our debt calculation. Yeah, there was actually a mistake within our team that we found with our paper. We got it graded back. So we wanted to make sure that change was clear when we pointed out that mistake.
Thank you.
In your general presentation, you guys didn't talk about capital allocation, but can you guys kind of talk about how they've used capital, what your assessment was of how is management doing in terms of managing return on invested capital for the company and their deployment of capital?
Yeah, we think management's doing a great job with this. The acquisitions have significantly increased market share as well as revenues consistently, and we see that to be the same going forward. Does that answer your question in full, or?
Well, did you guys take a look? So, okay, they've done acquisitions, so that's one way they can deploy capital. Did you try to do any kind of assessment on looking at a specific acquisition and doing what has been the return on investment for that acquisition as an example?
No, besides IPC Group in 2017, I think that was the only acquisition that we found the actual purchase price for the acquisition. I think it was, let's say 350 million. But besides that, we didn't really have data on what the acquisition was for Gamma. But no, we didn't do that sort of analysis.
Yeah, so I have a follow-up question just in terms of the coronavirus that's going on now. I don't know if you guys can sort of walk us through what the potential economic effects on the company are for the coronavirus.
Well, first of all, Tennant isn't immune to the global economy. So a few days ago, every market in the world was in the red. So as the market was, Tennant was down. This is just short term, and it will be less of an effect on Tennant, we believe, as Tennant has localized supply chains, aka the Americas region doesn't get parts, services, etc. from China, for instance, and vice versa. So those companies that have that non-localized supply chains will be more heavily affected, we believe. And I think we have one more.
To build off of that, we just think, and this might be somewhat of a childish example, but when you get sick at any point in your life, when we thought about this when we were kids, when you are sick and you come over that sickness, your inclination is to wash your clothes, change your sheets, do all these things. And so we think it's just human nature to want to be more cleanly after you have sickness. When you look at a worldwide epidemic where people are nervous because of sickness, the spread of disease, things like this, we see in the long term that a lot of people will respond by wanting their operations to be more cleanly, certain things like that. So in the long term, we see that there will be a higher push for cleanliness, and Tennant being a leader in the industry of cleaning, this will help with longer term sales.
Not to mention the potential need for artificial intelligence to make up for the lack of human capital. People are sick, there's a chance for the autonomous robots to kind of take those roles over to ensure that productivity continues in manufacturing plants, hospitals, etc.
Great, thank you.
Maybe can you talk about geographically, you still see the 6 to 7% growth in the North America, or Americas, right? So is that growth rate sustainable going forward? And what was the driver for that growth?
We see as Tennant as their main thing is they're a leader of innovation in the industry. With any innovation comes growth. So if they continue to innovate, we see this growth to continue to come along with that. Just because like as they grow, so is like their product offerings. So if they do continue to stay on track like they have been, we could see this to be long-term growth. However, like, I don't know, you can't really predict the future, so.
So I just had another question in terms of, I think your presentation, correct me if I'm wrong, was sort of doing evaluation just based off of DCF. So I just wanted to see if there was other valuation methods that you guys had used to kind of come up with different prices for the company.
We use the DCF, and then we also use the guideline company valuation, where we took, where we found revenue multiples and EBIT multiples from 6 different companies within the similar region, or similar industries, as well as market caps. And we applied these multiples to Tennant's figures, and that's where we got the 1.67 billion equity value that is weighted at 65%, and the DCF is weighted at 35% in order to come to our conclusion.
And just to follow up on that, the split between the 65 and 35%, what sort of caused you to kind of choose those numbers to kind of weight each one of those factors?
Strictly confidence.
I'm sorry.
We're very confident in the 65%. Thank you, everybody.